Imagine a world where you're earning a staggering $8,200 every month, and you're not even breaking a sweat to make it happen. Sounds too good to be true? Well, not in the world of Warren Buffett. Today, we're not just going to reveal the top 2 strategies to achieve this financial dream. We're diving deep into the genius of passive income. From the power of dividends to the smart play of covered call ETFs, we're unpacking it all. The best part is that we are doing the math to show you exactly how it is possible. So get ready, because we're about to begin a journey that could redefine your financial future. So let's start with this. Why passive income? Well, in today's fast-paced world, where economic uncertainties loom large and the traditional 9-to-5 job no longer guarantees financial security, the concept of passive income has become more than just a savvy investment strategy. It's a necessity for financial well-being. Passive income, which is money earned with minimal active effort, is the key to achieving a life of financial freedom and stability. It's about making your money work for you, rather than you working for money. The old model of working until retirement and depending only on savings is being challenged by the dramatic changes in the income generation landscape in recent years. This conventional approach is increasingly becoming unsustainable in the face of rising living costs, persistent inflation, and the unpredictability of the job market. In such an economic environment, depending on a single source of income is not just risky, it's potentially dangerous as well. The need for alternative income streams has never been more pronounced. Passive income streams, in this context, emerge as a vital cushion against these financial uncertainties. When it comes to making money, they offer a wider range of options besides the traditional paycheck. The concept of passive income is about creating avenues that continuously generate money with minimal active effort or involvement. This could be through investments, rental properties, or other means that do not require daily active management. The idea is to build a safety net that supplements, or in some cases, even replaces traditional income sources. A shocking number from the Federal Reserve shows that almost 40% of American adults would have a hard time paying for a $400 emergency with cash, savings, or a credit card charge that could be paid off quickly. This figure is not just a number. It's a stark indication of the fragility of relying on a single income source. It highlights the hard financial situation that many find themselves in, one unexpected expense away from potential financial distress. The reality painted by this statistic is a clear call to action. It emphasizes the importance of developing passive income streams as a buffer against the financial shocks that life can unpredictably throw our way. In a world where economic stability can no longer be taken for granted, passive income is no longer just a luxury. It's a necessity for those seeking financial security and a peace of mind. Warren Buffett, who is famous for giving great investment advice, has always pushed for investments that bring in money. The idea that you can make money while you sleep is important to him, and it is also what guides our research into dividends and covered call ETFs. As we circle back to our main topic, let's look at the first of these 2 strategies that can potentially lead us to earning $8,200 per month in passive income: dividend investing. This approach, coupled with the power of compound interest, forms the basis for a sound investment strategy.
The answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock.
Dividend investing involves buying shares of companies that pay dividends, a portion of the company's profits distributed to shareholders. These payments are typically made quarterly and can vary in size depending on the company's performance and dividend policy. Those who are looking for a consistent cash flow may find dividend investing especially appealing due to its capacity to generate a steady stream of income. After going over what dividend investing is and how it works, let's look at some real-life examples of companies that are known for paying dividends on a regular basis. These real-life examples will show you how dividend investing works and how it can be used to make a steady income. Number 1. Johnson & Johnson. A prime example of a dividend-paying company is Johnson & Johnson, a giant in the healthcare industry. Known for its stability and long history of dividend payments, J&J has increased its dividends for 58 consecutive years, making it a member of the elite group of stocks known as dividend aristocrats. This consistency makes it an attractive option for dividend investors. Number 2. Procter Gamble. Another notable example is Procter Gamble, a leading consumer goods company. PG has a track record of paying dividends for over 130 years and has increased its dividend for 64 consecutive years. The company's wide range of consumer products provides a stable revenue stream, which in turn supports its strong dividend payments. Number 3. Coca-Cola. Coca-Cola, the beverage giant, is another excellent example of a consistent dividend payer. It has paid a quarterly dividend since 1920 and has increased dividends annually for the last 59 years. Coca-Cola's global brand strength and market presence make it a key item in many dividend investors' portfolios. Number 4. AT&T. AT&T, a leader in telecommunications, is known for its high dividend yield. While its dividend growth rate is slower compared to some other companies, its current yield is attractive, making it a popular choice among income-focused investors. These companies exemplify the kind of stable, well-established businesses that are favored in dividend investing strategies. They have a history of not only paying dividends consistently, but also increasing them over time, which is a key factor in generating growing income streams through dividend reinvestment. By investing in such companies, investors can tap into a source of regular income that has the potential to grow over the years, aligning well with the goal of building a robust passive income portfolio. Now let's understand the role of compound interest. Compound interest plays a pivotal role in maximizing the potential of dividend investing. It's often described as interest on interest and is the result of reinvesting earnings rather than paying them out. This means that dividends received are used to purchase more shares of the stock, which in turn will generate their own dividends. Over time, this reinvestment leads to exponential growth in your investment portfolio. To illustrate, let's assume you invest in a portfolio of dividend stocks with an average annual yield of 4%. If you start with an investment of $100,000 and reinvest all dividends, your portfolio will grow significantly over the years due to the effect of compound interest. The key here is time. The longer you allow your investments to compound, the larger they grow. Let's do some math to see how investing in dividends can lead to a monthly passive income of $8,200. Remember, Warren Buffett believes in the power of compound interest and long-term growth. The goal is to generate $8,200 per month, which translates to $98,400 annually. To assume this target through dividends, we need to determine the size of the investment required, assuming an average annual dividend yield. For this example, let's consider a realistic dividend yield of 4%, typical for a diversified portfolio of stable dividend-paying stocks. The first step in our calculation is to figure out the total investment needed to achieve an annual income of $98,400 at a 4% yield. This is calculated by dividing the annual income goal by the dividend yield percentage. Therefore, the required investment would be $98,400 divided by 0.04, resulting in a total of $2,460,000. This means that to generate $8,200 per month in dividends at a 4% yield, an investor would need to have $2,460,000 invested in dividend-paying stocks. However, not everyone has such a substantial amount to invest up front. This is where the power of compound interest comes into play. Suppose an investor starts with a smaller initial investment, say $500,000, and chooses to reinvest all dividends received. In this scenario, the investment would grow over time, not only from the initial capital, but also from the dividends that are reinvested. This compounding effect can significantly increase the value of the investment over the years. For example, if the total return, including reinvested dividends, averages 7% annually, then it would take about 20 years for the initial $500,000 investment to grow to approximately $2.4 million, the amount needed to generate a monthly income of $8,200 at a 4% dividend yield. This calculation assumes that all dividends are consistently reinvested and that the average return remains steady over 2 decades. Getting a monthly income of $8,200 from dividend investing is a realistic goal, especially if you look at it over a long period of time. It requires a significant initial investment or a smaller amount that can grow over time through the power of compound interest. This strategy aligns with Warren Buffett's investment philosophy, emphasizing the importance of patience, reinvestment, and a focus on long-term value creation. By starting with whatever capital is available, reinvesting dividends, and allowing time to contribute to the growth of the investment, achieving a substantial monthly passive income through dividends becomes an attainable financial objective. In our second strategy to achieve a monthly passive income of $8,200, we focus on covered call exchange-traded funds, or ETFs. This investment approach combines the potential for regular dividend income with earnings from selling call options, creating an attractive opportunity for enhanced income generation. Covered call ETFs involve holding a portfolio of stocks and selling call options on these stocks. The strategy generates income from the premiums received for selling the options, in addition to any dividends from the stocks. This dual approach can offer higher income potential compared to traditional dividend stocks, especially in markets that are not rapidly rising. Now let's look at some real examples of covered call ETFs with a trailing yield period of 12 months, giving approximately 12%. Number 1 is Global X NASDAQ 100 Covered Call ETF. QYLD follows the NASDAQ 100 index and sells covered call options on the index. Over the past 12 months, QYLD has offered an impressive yield of approximately 12%. This high yield is attributed to the income generated from option premiums on top of the dividends from NASDAQ 100 stocks. Number 2 is Global X S&P 500 Covered Call ETF. XYLD applies a covered call strategy to the stocks in the S&P 500. It has also demonstrated a trailing 12-month yield close to 12%, combining the stability of S&P 500 stocks with the additional income from selling call options. Number 3, Horizons S&P 500 Covered Call ETF. HSPX is another ETF that employs a covered call strategy on the S&P 500 index. With a similar yield to XYLD, HSPX provides an alternative for investors looking to diversify their covered call ETF holdings while still targeting a yield around 12%. Given the approximate 12% yield from these covered call ETFs, let's calculate the investment needed to achieve a monthly income of $8,200. To calculate the investment needed to achieve our goal of $8,200 per month, or $98,400 annually, we use the yield as a key factor. With a 12% annual yield, the formula to determine the required investment is straightforward. Divide the annual income goal by the yield percentage. Therefore, the calculation would be approximately $98,400 divided by 0.12, resulting in a required investment of approximately $820,000. This calculation implies that with an investment of around $820,000 in a covered call ETF yielding 12%, an investor could potentially generate a monthly income of $8,200. It is a significant sum, but the high yield offered by these ETFs makes the target more attainable compared to strategies with lower yields. It's important to note that while the high yield of these ETFs is attractive, it also comes with its own set of risks and considerations. The income from selling call options can fluctuate based on market conditions, and the cap on potential capital gains from the underlying stocks due to the option contracts is a factor to consider. Therefore, investors should carefully evaluate their risk tolerance and investment goals when considering covered call ETFs as a strategy for generating passive income. In conclusion, our exploration of dividend investing and covered call ETFs illuminates two powerful strategies for achieving a substantial monthly passive income. Whether you're drawn to the steady returns of dividend stocks or the higher yield potential of covered call ETFs, both paths offer viable routes to financial freedom. Remember, the journey to $8,200 per month in passive income starts with a single step, and that step is yours to take. If you found these strategies insightful, please share your thoughts in the comments below. We'd love to hear about your investment experiences and any additional strategies you've found effective in your journey towards financial independence.